Welcome to the Tax Show. I'm Brian Whitman. Peter Stephan is here from the Tax Resolution Institute. Jim Felton from Greenberg and Bass. We're here every Sunday afternoon talking about taxes, tax problems, tax resolution. And Peter of the Tax Resolution Institute literally wrote the textbook. So if anybody gets out of line, he whacks them over the head with it. It weighs, I think, 800 pounds, the textbook on it.
It's a pretty big book, Brian.
The good news is, I don't have to know what's in it because you wrote it. I just go to you at the Tax Resolution Institute. You're the guy who literally wrote the book. I love that.
That's correct, yeah.
Yeah, and I'll tell folks in a little bit here as we continue just how you help me out. Jim Felton of Greenberg and Bass. Greenberg and Bass in the Valley has been around a long time.
We have, Brian. We've been around since 1984. Our principal practice is a bankruptcy-related practice representing individuals and businesses in either Chapter 7, Chapter 11, or Chapter 13 matters. Oftentimes, those involve tax matters, which is why Peter and I and the Tax Resolution Institute have had such a good relationship.
That's why I call you the Tax Tag Team.
There you have
It's
it.
the Tax Tag Team.
That's probably a pretty good name.
I can't take credit. You got to give that guy credit over there. Yeah, So you guys, it's not uncommon where you work in tandem to help one client, as we talked about a couple of weeks ago.
That's correct. It is not uncommon at all. In fact, it's usual because most people that have creditor issues probably have an IRS or an FTB issue, maybe even an EDD issue. So oftentimes we're looking out for each other because the clients that come in, Peter's side, sometimes they perhaps need to think about a bankruptcy. And certainly on my side, when I see a client, oftentimes they have a tax issue that requires the specialized help of the Tax Resolution Institute.
Peter Stephan of the Tax Resolution Institute, taxresolutioninstitute.com, I like to tell people. I read something this week, and I said, when I see you over the weekend, I got to ask you, because I don't know if it's true, but I know you'll know. The suggestion of item I saw online, that now, this year is a good time to seek an offer in compromise from the IRS. People hear all the time, you and I have talked about them in the past. People owe $50,000, but they settle for pennies on the dollar, right? You hear this all the time. Does that really happen to that extent? And is now really a better time than before to pursue an offer in compromise?
Now is probably the best time to pursue an offer in compromise because the IRS changed, they loosened up the offer in compromise rules early last year. They still want all your assets, and they still want some of your, what they call your disposable income. But they've gotten to a point where they take a smaller multiple of your disposable income. To make it simple, let's say that we calculate your disposable income at $1,000 a month based on the way the IRS would calculate it for purposes of an offer in compromise. Before, they wanted $48,000. Now they want $12,000.
Oh, that's quite a change.
So it's a huge change. So people with no assets and people with little or no disposable income, we typically settle cases for truly for pennies on the dollar. We don't like to sound like we're the middle of the night TV pennies on the dollar type commercials. But the truth of the matter is we've settled $5 million for $5,000.
$5 million for $5,000.
$36,000 for $500. $279,000 for $1,085.
Okay, let me ask, as a regular guy, I mean, I'm not the Tax Resolution Institute specialist, Peter Stephan, who wrote the book. I'm not Jim Felton from Greenberg and Bass. I'm just Brian, the guy who had a tax problem and called the Tax Resolution Institute, and you guys fixed the problem for me. How does that happen where somebody owes $5 million and then settles for, what, $5,000?
Correct.
I mean, clearly something happened there. I mean, how is that even possible?
Well, in this particular case, we had a man who, in his late 50s, early 60s, made a substantial amount of money. He was in a business that sort of came and went quickly, but made $4 or $5 million, and on top of it, was audited. So he didn't have very good records. I didn't know the guy at the time, fortunately. I didn't prepare the returns. And at the end of the day, with interest and penalties, he owed $5 million to the IRS.
Wow.
So when he came into the office, he like everybody else, said, I need to get this liability off my back. I'm collecting Social Security, but I'm going to make millions of dollars somewhere down the road here. And they pretty much all tell me the same thing. And you know, one out of maybe 50 of them do. But I take it with a grain of salt, and I look at their financial condition, and because of the man's age, his having no assets, but for a leased car. It was actually a pretty easy offer.
So are you saying in this case the IRS was, dare I say, merciful to the taxpayer?
Well, they had no choice because he fell right in the formula. There wasn't any income on the side. There wasn't the income was clear. The Social Security and small amount of income he was earning was going right into his bank account, and so he fell right into the box.
And formulas exist from the bankruptcy perspective as well. People, if they qualify for Chapter 7, then we can put them in a 7, which basically gets rid of all of their debts. If they have too many assets for a Chapter 7, we can put them in a Chapter 13. It really depends strictly on the formula. The fact that they may have made millions 3 or 4 years ago makes no difference. It's what do their current assets look like, what do their debts look like, and what can we do for them based upon that financial picture, not what happened years ago.